relates to a question that I got. You just were one step ahead of me. Using short puts. So I had said to you that to buy a stock, many times instead of just purchasing the stock, I will back into it by shorting a put against that stock. So I actually learned this strategy. I'm reading an article about Warren Buffett, again, greatest investor of all time, pretty good guy to copy. And in the article, it talked about the fact that, ironically, Coca-Cola, Buffett owns a lot of Coca-Cola, not a lot of Coke. Today's world, different connotation. So he owns a lot of Coca-Cola. He likes the company. He understands the product. And at the time, Coke was trading for $39 per share. And Buffett thought, I love my position, but if that stock ever came down to, say, 35, I'd be willing to buy everything I could get my hands on. So instead of just sitting there and hoping that the stock came down to 35, he shorted a put with a 35 strike, which would now obligate him to what? Buy the stock at 35, which he was, but now he's going to get paid. He did this for a year. So he received $1.50 in premium. And because of the size of what Buffett does, that brought in $7.5 million. And I thought, hell, I'd like to make $7.5 million in a day. I've never done that. So maybe I should learn the strategy. And yeah, I can't do as much as Buffett, but maybe I can do some piece of it. This is what inspired me to learn the strategy. By the way, I was teaching a class somewhere, and it was a stock class and an options class. So the first part of it was all about stock, second part all about options. So we were on the options piece, and I had a guy in the class who said, well, if options are so great, how come Warren Buffett doesn't use them? I'm like, what makes you think Warren Buffett doesn't use options? Well, I've never heard of it. I said, I'm guessing based on your statement, there's a lot of things you haven't heard of. It doesn't mean they're not true. So what I did was on my lunch break that day, I went into the Berkshire Hathaway A fund, and I found that that year, Buffett had made $5 billion on his option positions. And the guy's like, I'm stunned. I'm like, yeah, maybe next time he'll call you. So here's kind of the protocol for this strategy. First, you got to find a stock that you want to own. Maybe it's off that FinViz list, right? But something else, or it could be for me, because I've been around this for 4 decades, there are companies that I just like, right? I know all about them. I've already done the research. So if I see something I really like, a good example, the last one I did was on NVIDIA. NVIDIA was $130-some stock, came down to 100. And I'm like, I'll take all of that I can get, right? So I started shorting puts with a strike price of 95 and ended up picking up another 500 shares at $95 a share. Now we're back up to whatever, 115 or thereabouts. So you need to identify something that you want to own, identify a target price. So on most stocks that I follow, there's a price at which I'll own more, not unlike what Buffett did. It's like, hey, I like Coke. If I could get more at 35, sign me up for that. So then you sell a put at that strike price. You keep the premium no matter what. So like on that NVIDIA, right? I short a put, collect the premium. No matter what happens, I get to keep the premium. If the stock falls to the strike price, then hopefully I get to own the stock. So I'm only doing this on stocks that I want to own and have the money to buy. And then once I acquire the stock, then I start selling calls against it, which creates all this cash flow and reduces my risk in the stock. So we identify a fundamentally strong company, sell short puts against it, capture that premium, hopefully get the stock, write covered calls against it, and drive down our cost basis. So let's take, most of the stocks have been up recently, but let's go back to, let's just look at NVIDIA for a minute, since I'm eminently familiar with it, and the same sort of thing would apply. NVIDIA, and because it's not a terribly expensive stock, at 116 bucks. So I'm looking at NVIDIA, and let's say that in my mind, if NVIDIA dropped below 110, that I'd want to own some more of it. Typically, I'll go out like a month on these. You could do weeklies. Let's see what we can make. So if we went out only 6 days, so here's the puts on this side at 110. So we would collect about 70 cents per share. So that would make the net cost 109.30. So let's say that I wanted to do that for the 6 days, and I was willing to buy just 100 shares of the stock. I would just go -1, hit the trade button, and I'd go to the midpoint, right? So I'm going to get 71 cents a share. So if NVIDIA does not drop or is not at 110 or below at expiration, then I just keep this money, this $71. And then the next week I could do a new one. And next week, another one and another one and another one, until ultimately the stock falls and I pick up the stock. So while I'm waiting for the stock to fall, I'm getting paid, which I think that's pretty cool concept. Get paid to wait, right? None of you would have an issue with that, I'm assuming. Now, what if NVIDIA starts shooting up? Then I'm going to stop doing it on NVIDIA, because I won't get anything. If NVIDIA goes to 125, shorting a 110 strike put isn't going to pay anything. What if NVIDIA came down to 112 at expiration? Then maybe I short a 105, see if I can get it even cheaper. So again, it is simply a strategy for getting paid to commit to buying something that you would want to own anyway at a discount. And then if I do acquire the stocks, then I start hitting it with these covered calls. So everything is designed to push down my net cost. So let's say now I own NVIDIA and I got 1,500 shares of it right now. Selling covered calls at, say, 117 brings in $2.38 a share. So it drops my net cost. So if I look at this and I go, okay, I can bring in 238 for 6 days. If I multiply that by 60.8 over the year, it brings in $144. The stock's only 116. Right now, the way NVIDIA is priced, doing covered calls against it, if nothing changed, I could get all of my money back in a year. Once you've got all your money back, how much risk do you have? Zero. So on something more volatile like NVIDIA, although you've got to manage those covered calls carefully and really know what you're doing, it creates big yields. Now, something like Coke, All right, so the return on that was 30%. But still, think about it. In 3.5 years, you would have recovered 100% of what you paid for your Coke stock. So my ultimate vision for you, remember yesterday I talked about build an account, learn to create income, right? Live off the income, and then all the shares get passed through to the next generation. Remember that whole deal? I want to add one thing to it. I want these shares that you own to ultimately be risk-free. Could you imagine if you owned a portfolio of stock where you've already received more than 100% of what you paid for the stock, and you have no risk in them at that point, right? You're playing on house's money, and you're generating 20, 30, 40, 50% a year in pure cash flow. That is exactly what I did with my dad at retirement. It's exactly what I've done for myself. It is a beautiful position to be in, but to get there, you need to sort of have a combination of skills. You need to know how to pick a stock. We did fundamental analysis yesterday. You need to know how to short a put. We talked about that yesterday and today. You need to know how to do a covered call, which we've talked about today. So you start putting all these skills together with the objective being that you're able to eliminate your risk over time, have this beautiful portfolio you're going to be able to pass along to the next generation, and massive cash flow while you're alive so that you can live the life that you want to live. And if you're not getting a little bit excited now that you see how some of these things come together, either I haven't done a good job of explaining it or you haven't done a good job of listening. This is life-changing. This is life-changing. All right. Take a couple questions on shorting a put to acquire a stock. Sorry, I missed how you selected the strike price when selling the put. Did I pick a delta of 80? No. I determined in advance the price that I was willing to pay for the stock. That's my strike price. Your NVIDIA example for shorting puts, you're rolling these as well each week. You could. Even if out of the money, I wouldn't be doing them. Yeah, well, they're out of the money. Yeah. Even if out of the money, you're paying, no, on these, that's a really good question. So on expiration, yeah, I'm going to buy them back, right? Hopefully for pennies if they're out of the money. And then I'll just sell a new one for the following week, just like with covered calls. It's a great question. Would you need to buy back the short? Yep, same question. If the stock price drops near, but not to the put strike price, you just roll forward 1 week. Yes, remember what I said? I could adjust that strike price. So maybe I drop it a little bit. What do you mean by premium collecting? That's what you collect when you sell your option. Premium is the price of the option. Could you show your FinViz? You've already got it. On short puts, do you have to buy to close? Yep. Just like with the covered calls. Okay. We got to cover one more strategy before this next break. You guys are doing great. I sense your excitement. You can tell I get a little fired up, right? And I live these strategies. You know why I get fired up?